All right, well, I hope everybody's enjoyed the program so far. And now it's time to move on to the second part of our presentation, and we're going to bring up our Senior Portfolio Manager, Steve Shipman. Steve has been with our firm for 4 years. He has 27 years of industry experience, but we have been working with Steve for about 20 of those years. When we were back in Los Angeles, Arnold used to meet with Steve and Sam Hale and a few other gentlemen and talk about investment philosophy and ideas and what have you. So we really feel like he's been part of our team for many more years beyond the 4 years that he's officially been with us. So as a senior portfolio manager, Steve meets with Jim and Arnold every day in the portfolio manager meetings. These on typical days are 2 to 3 hour meetings talking about the strategies and reviewing the different buy and sell decisions that are made in your portfolio on a daily basis. And for those of you that have had a chance to talk with Steve, you also know that he is truly a market historian and a key member of our team. So now if you'll join me in welcoming Steve Shipman.
Thank you, Scott. Arnie started this morning by thank you for being here. I'm going to start by thanking you for staying here. He is a tough act to follow in many ways, and one of the ways is how he spends his time, not just following him in speech. And today I have an example for you of the kind of guy Arnie really is, and that is with us are 13 students from Texas Lutheran University who he invited to attend and who he's been working with for the last couple of years, educating and getting them induced into the value philosophy so that they, in the future, will become Arnold Vandenberg. So all the gentlemen and ladies that are here, would you raise your hand from Texas Lutheran, and welcome and thank you for coming. We expect stock picks right away. The idea for my part of the presentation actually comes from a good discussion that we had with a long-term client who had noted that we have had better than market returns over the years and with less risk, but was asking whether or not we shouldn't have had more return or less risk. And I think it's a good and legitimate question, and that's some of the aspect of my presentation today, which is to go over the elements of return in our portfolio, but even more importantly, to discuss with you how we look at risk and volatility, because it's a little bit different than the way that the market does. If we look at the last 39 years of our history, the firm has generated better returns, but even more importantly, more consistent, more predictable returns than the marketplace has in general. If we look at those first 39 years, note a couple of things in the chart that we're showing. The first is that the Century Management returns are very much concentrated around those middle of the chart, as you can see, a 10 to 15% return. Those returns have happened about 28% of the time. Secondly, if you look closely at the chart, you'll also notice that over 70% of the time, the returns from the Century Management portfolio have been 10% or more. And finally, if you look at the downside of the chart, those years where there were losses, there were only 4 so far in the last 40 years, almost 40 years, or 10% of the time. And only one time was that loss more than 10%. Now, if we compare the outcomes of the Century Management portfolio to the S&P, we find something very different. Unlike the returns of the Century Management portfolio that are concentrated around the middle part of the graph, that 10 to 15%, the market returns have been aggregated along the edges. You can see that about 18% of the time you could get fairly big returns from the market, 30% plus. But also 18% of the time you could get losses. So the amount of time that the market spends in the loss category versus Century Management is about twice as long. If we look even closer at the loss side of the ledger of the S&P's returns, you'll notice that those losses are actually concentrated on the greater end of the returns. Over 8% of the time, the losses in the market portfolio, exceed 10%. That's 1 out of every 12 years. And another 8% of the time, the losses in the market are somewhere between -5 and -10%. If I line the two portfolios together, so we're looking at both Century Management and the S&P 500, it becomes very obvious that the Century Management portfolio has less erratic outcomes, more predictable returns, and less frequent losses than the market does. And that's despite the fact that our portfolios have had, as you know, a good smattering of small cap and mid cap stocks. So the question becomes, how can that happen? Our answer is, it lies in our investment philosophy, the value philosophy. We truly evaluate stocks as discrete businesses, and we will only buy those businesses when we think that we have a good enough deal to protect to the downside, no matter what adverse outcome there might be. It's our experience that the intrinsic value of the business doesn't change very much, although the price of the stock changes a lot. We call that process identifying value gaps, and all of you who were here last year heard Jim give quite a discussion on what that value gap is and what that means to us. For those of you who weren't here last year or would like to review that, it's on our website, and please review it at your leisure. So you can buy the 500 companies of the S&P, but you have to take the prices that Mr. Market gives you. Sometimes he'll give you companies that are overvalued, and sometimes he'll give you companies that are undervalued. But none of these are handpicked because they offer the margin of safety that we find necessary to protect from the permanent loss of capital. That's our definition of risk, avoiding the permanent loss of capital. That's the hallmark of true absolute value investing. And paradoxically, by sticking to that discipline, not only will you preserve that loss of capital, but over a reasonable period of time, you should also have a pretty handy outperformance. Now, fundamental to knowing how to avoid that permanent loss of capital is being able to distinguish between the difference between risk and volatility. Most institutional investors and most advisors to high net worth individuals like yourself describe risk as how much does the return swing around the average. And as we saw in the S&P 500 chart that was up, that S&P 500 swings pretty wildly, about 36% of the time. Now, in contrast, let's look at the nature of risk and volatility within the framework of the value philosophy, especially as we practice it at Century Management. We find there's at least 4 significant triggers of what I would call macro sources of risk. That is, risks that are outside of the company's control, risk that's coming from the external environment or the economic environment. First, there's changing technology. Innovation happens, and it's the hallmark of the capitalistic societies. Arnie talked about some of those innovations that are forthcoming, and Jim, in the upcoming discussion, will also talk about those innovations and how they play in our portfolio today. But just think about changes of technology in my lifetime in the computer industry. We saw mainframes give way to mini computers, and mini computers give way to PCs, and now PCs are giving way to tablets and to smartphones. The second macro source of risk is competition. Entrepreneurs figure out how to do things better and cheaper, and if they abound, so does competition. Think about the once mighty five and dime stores that succumbed to the department stores that gave way to the specialty stores that are now in a fight for their life against Amazon and all the internet companies. Or just think internationally. When I was growing up in the 60s, people sneered at Japanese automobiles. Now they're top of the heap, yet they're being chased by the Koreans. A third source of macro risk to any company are natural disasters. From time to time, they can truly wipe out a business. Most recently, we saw some torrential, once-in-a-lifetime floods wipe out parts of Thailand, and with that disrupting one of our businesses and many of the businesses that they served. And finally, there's government regulation. Let me cite two and go first to Sarbanes-Oxley, which many of you may have remembered in 2002, initiated because of the malfeasance of Enron. And during that time, you saw the market fall 20% in 6 weeks from the middle of June to the end of July. Most recently, we've seen a similar malfeasance by some financial companies back in 2007, 2008, bring on another regulatory blunderbuss, the Dodd-Frank Act, which was signed into law in 2010. We're just beginning to understand what that means to have the federal government micromanage the financial industries. Now, in addition to these macro sources of risk, again, risks that are outside the control of the company, there are a couple of other elements of risk that are inside or internal or intrinsic to the company. And I would say, I label those micro levels of risk. And there are at least two major micro levels of risk that we take into consideration and evaluate at Century Management very seriously. You've often heard us talk about companies that take on excessive debt and the economic jeopardy that that places them in. How many times have we heard the story of companies that get complacent about their business and try to eke out additional meager profits by jimming up their balance sheet, only to find out that they take a turn in business and get out of and lose their business. Usually it's not the sales volume decline that kills that business. Usually it's the required debt payment. The second internal source of risk that we examine in a business is associated with the management of the company. Sometimes the managers will put their business at risk, wittingly or unwittingly. Sometimes they fail to execute their business plan. Sometimes they seek grandeur by acquisitions and mergers. Sometimes they're just incompetent. But they do represent a serious form of risk to the business. So these are the things that we look at Century Management as defining risk. Not the variability of our expected returns, but what can sink the business. Risk has nothing to do with those variability of returns. Now, as opposed to risk, which is a threatening condition to investing, let's talk a little bit about volatility, which we actually think is a friend of the value investment process. We see volatility as opportunity. And we define volatility simply as the movement of stocks around the intrinsic value of the business. So by this definition, volatility occurs both when the price of stock falls and creates a buying opportunity for us, or when the stock rises and creates a selling opportunity. Now, what can cause these extreme actions of prices? We know that investor psychology and emotions fuel some of that price action, and we know that the intrinsic value of the businesses don't change that much. So let's look at some of these sources of volatility, and I'm going to break them down in the same way I did risk, macro and micro. When we look at the macro sources of volatility, I can identify at least 4 elements. The first cause of price dislocation can occur when there's an announced change of tax policy. Sometimes that comes from the executive branch, sometimes it comes from the legislative branch, But no matter where it originates, if it looks like there is going to be a change in the status quo, that will have an effect on prices. The second source of volatility in terms of price dislocation will happen from a change or an expected change in Fed policy. This has been particularly acute recently, as you know, from the headlines with the Fed talking about its tapering policy and the changes that are involved in that. Thirdly, geopolitical events can cause volatility. Most recently, we saw this a couple of months back when there was some concern that the United States was going to get involved in an effort to attack Syria. And finally, there is very often changes in prices when there are changed expectations about the growth of the economy. We saw this most recently in 2011 during the Greek crisis and the European events, where many investors here in the United States thought that that would leak over into our borders and cause a recession. Now, depending upon the extent of these particular changes, any or all of them could cause fluctuating prices that create opportunities for us. The important thing to consider is not the magnitude of the changes that we see in the prices of these stocks. The important thing to consider is because the intrinsic value of the businesses don't change very much, we get a chance to buy and invest our monies in these companies. Now, in addition to the macro sources of volatility, there are also a couple of micro sources, or sources that are endemic, intrinsic to the companies themselves. And let me run through a couple of those very quickly. One is prices in a stock will change when there's a surprise to the earnings, or they disappoint with their earnings. Or more recently, what's happened is companies guide the street about their sales or about their earnings being higher or lower. Any disappointment there can cause a temporary change in price. Another source of micro volatility will come from an expected change in the growth rate of a company's earnings. Now, I'll use an example of our typical small cap cyclical stock. We're usually not buying these on the basis of earnings because there aren't any, but we can buy them on the basis of assets. The potential gains are modest at best, as you see in this PE example, where we'll stretch from somewhere from 7 to 9 or 10. However, when the prospects of a company's earnings improve, as you can see, so will their PE. Just small changes in expected earnings increases can lead to very large changes in PE multiples. And of course, the opposite is true. As soon as the companies hit their cyclical peak and start to go the other way, investors will reduce their expectations. Third source of volatility when it comes to stock price changes are product failures or successes. Think recently about the Apple iPod and the Apple iPad announcements and what that does to the price of Apple stock. And of course, those of you who are old enough to remember, I was the Edsel. There's a great source of product failure. A fourth source of volatility of stock prices is the death of a founder or the death of a very competent and capable CEO. Or, of course, the opposite is true, and that is you have a company that is languishing and a competent CEO joins the company offering hope and opportunity. We think we have one of those in your portfolio with a company called Lane Christensen. And we had a great experience with the CEO that you see in the picture, Rene Robichaud, who turned around a company that we had in our previous portfolios, NS Steel. Now that he's at the helm of Lane, we think he has a great opportunity to do just the same. The final source of volatility in stock prices comes from the government again, a government investigation or a lawsuit. Sometimes they will announce that there's an inquiry. Most recently, for instance, the Justice Department has been using the Foreign Corrupt Practices Act, a piece of legislation passed in the 70s, to go after companies and extract revenue for the government. So whether or not these exaggerated price swings happen because of a macro event or they happen because of some micro event, these are occasions that create opportunities for us, and we want to take advantage of them. Now, we've talked about some of the elements of return, about some of the elements of risk and volatility. We have an investment process, we think, that tries to make money in all markets. And so the discipline that we have allows us to focus on the intrinsic value of the companies and ignore the emotional day-to-day swings of the general marketplace and investor psychology. That's the secret to the value investing proposition. Now, in the next part of the presentation, my colleague Jim will talk about another important aspect of investing with a margin of safety, and that is how to avoid value traps. So Jim, I leave it to you.